Welcome to the Dakota Live podcast. I'm your host, Robert Morier. The goal of this podcast is to help you better know the people behind investment decisions. We introduce you to chief investment officers, manager research professionals, and other industry leaders to help you sell in between the lines and better understand the investment sales ecosystem. If you're not familiar with Dakota and our Dakota Live content, please check out dakota.com to learn more about our services. Before we get started, I need to read a brief disclosure. This content is provided for informational purposes and should not be relied upon as recommendations or advice about investing in securities. All investments involve risk and may lose money. Dakota does not guarantee the accuracy of any of the information provided by the speaker who is not affiliated with Dakota. Not a solicitation, testimonial, or an endorsement by Dakota or its affiliates. Nothing herein is intended to indicate approval, support, or recommendation of the investment advisor or its supervised persons by Dakota. Today's episode is brought to you by Dakota Marketplace. Are you tired of constantly jumping between multiple databases and channels to find the right investment opportunities? Introducing Dakota Marketplace, the comprehensive institutional and intermediary database built by fundraisers for fundraisers. With Dakota Marketplace, you'll have access to all channels and asset classes in one place, saving you time and streamlining your fundraising process. Say goodbye to the frustration of searching through multiple databases and say hello to a seamless and efficient fundraising experience. Sign up now and see the difference Dakota Marketplace can make for you. Visit dakotamarketplace.com today. Well, I am thrilled to introduce our audience today to Sam Johnson of Loyola University Chicago. Sam, welcome to Philadelphia.
Thanks for having me. It's exciting to be here.
Yeah, thank you for being here. I'm sorry that you got in a day late for Sturgill Simpson, but we'll try to get you there next time. It's great to have you here at the desk at the studio. Tim Dolan, always good to see you.
Appreciate it. Thank you.
Thanks for being here. Thanks for taking time off the road. How has it been for you?
All is good. It's nice. Allocators are back in the office taking meetings, which is very excited, and obviously pumped to have Sam here and learn more about the endowment at Loyola.
Yeah, we are too. Thank you so much. Well, before we get started, we have a lot of questions to ask you, but I'm going to read your biography for the audience. Sam Johnson joined Loyola University Chicago 3 years ago as an investment officer and quickly worked his way up to director of investments. In his role, Sam is responsible for the university's investment portfolio, including managing Loyola's $1.2 billion endowment. His responsibilities include ensuring that donor funds are appropriately invested, and he works closely with external asset managers to align investments with Loyola's policies and long-term goals. Sam began his career at GCM Grosvenor, where he spent 7 years in roles ranging from analyst to principal. His experience there built his expertise in managing institutional portfolios with a focus on asset allocation and partnerships with external managers. Loyola has made a strategic shift in their endowment from a generalist approach in equities to a specialist model, which was recognized as a key factor in the success of Loyola's endowment. Sam has been named an Institutional Investor Rising Star for his contributions to this transition. Sam holds a BA in economics from the University of California, Berkeley, and is a CFA charter holder. For those unfamiliar with Loyola University Chicago, it's one of the largest Jesuit Catholic universities in the United States, with nearly 16,600 students. Founded in 1870, it's ranked as a leading national university by U.S. News and World Report. Loyola's endowment is made up of over 15,000 individual funds and plays a critical role in supporting scholarships, academic programs, research, and faculty salaries. It's a pleasure to have you here today, Sam. Thank you so much for being here, taking time out of your schedule, and welcome again to Philadelphia.
Thank you. It's great to be here.
Well, it's been 10 years since your days on UC Berkeley's campus. So for our students who listen to our show, can you talk about those years in undergraduate and what you were thinking about in terms of your career?
Of course. So I started at Cal in September 2010. I'd grown up in Milwaukee and just kind of wanted to try something different. So I went out to Cal for school. I studied economics. When I started, I thought I wanted to be a professor. So I did a dual major with econ and math. The summer after my sophomore year, one of my econ professors had asked me to help work with him on one of his big projects. So I did that for the summer. And after that, decided I no longer wanted to be an economics professor. I'd always had a passion for investing. I'm not really sure where it came from. When as I said, I grew up in Milwaukee, and one of my earlier experiences, my dad took me to Chicago for my birthday one year, and we were staying at the hotel and having breakfast in the morning. And I actually pointed out to my dad, as an 8-year-old, I saw Warren Buffett sitting across the room eating breakfast by himself, and I said, "Hey, Dad, I think that's Warren Buffett." And he said, "No, no way." And then kind of like peeked over, and like sure enough, it was Warren Buffett. And by the end of breakfast, he was mobbed by people, but at that time, he was the only one there. So not really sure where the passion for investing started, but no, it started at an early age. My parents got me Intelligent Investor. They were both in the healthcare field, so didn't really have any experience in investing or kind of understand the career path. But kind of helped me out. My dad obviously knew who Warren Buffett was, and got me some of the books. I started watching Mad Money, funny enough, in high school, and this was kind of 2007, 2008, 2009 timeframe. So obviously a lot going on in the markets, and there I am as kind of 15, 16, 17-year-old having absolutely no idea what exactly is going on, and a little more appreciation for it now, but obviously interesting time to try to learn investing. When I got to school, I joined an investment club called Berkeley Investment Group. It was a group of students that were all really passionate about investing. And the group managed a chunk of money. It was actually all kind of student and former student money that they'd grown over time. Those at the time, I think it's changed now. But yeah, it's about 30 students. It was a program that you would apply to, and they would pick kind of 10 students every year to be a class. So I joined the Berkeley Investment Group, applied my freshman year, got in my sophomore year, and they teach a class, upperclassmen teach a class to the underclassmen. Just going through kind of basics of investing, doing kind of how diligence works, investment modeling, kind of portfolio management. And then you go through that class and then you become an officer in the group. So that was a pretty formative experience for me during college outside of my studies in economics. So I'd say those two things were kind of the biggest part of my learning in investing. And actually how I found my first job at Grosvenor was through Berkeley Investment Group, which was pretty cool.
It never ceases to amaze me how many of our guests were part of a student investment fund in their undergraduate years. Drexel University has the Drexel Fund. It's actually the best performing fund manager of any of the funds in the asset allocation model over the last 10 years. So I'd be curious what the performance looks like of Cal's relative to other managers, but it's great that you had that experience. And the fact that you could spot Warren Buffett at 8 years old, if I could spot Mike Schmidt, I'd be a lucky guy, a lucky kid, but that's pretty impressive. But it's great that your parents supported that passion of yours. So thank you for sharing all that. So there's various roles earlier in your career, including Grosvenor, which you mentioned. What were some of those pivotal moments that shaped your path towards endowment management?
I interned at Grosvenor summer of my junior year of college, and then rejoined full-time in the fall of 2014. Started in their analyst program. So it's a three-year analyst program. I was on the Equities team, and kind of there's a really steep learning curve when you come out of college and start in the investment world. There's obviously a lot to learn on a lot of different strategies. I was kind of throughout college very kind of I was really like dyed-in-the-wool value investor, but I certainly believed. Remember one of my friends pitched me a stock, and it was like 25 times earnings. I was like, "Oh, you're insane! Paying anything more than 15 times for a stock." This was 2010. So I mean, you could have bought Visa at like 20 times earnings. But kind of really opened my mind to all the different ways to make money in the stock market, and even outside of the stock market, there's a lot of different asset classes where people built really impressive firms and different ways to, I guess, make returns for your investors. The first 3 years at Grosvenor in the analyst program, you're really drinking from a fire hose, learning every day, learning all these different strategies, talking to all these really, really interesting people. Got promoted out of the analyst program to associate after the 3-year program was up, and then finally to principal. So this is my career path at Grosvenor. So Grosvenor was a really fantastic place to start my career. Like I said, you feel like you're drinking from a fire hose every day, just the amount of information. It's a very large asset manager based in Chicago, and you see a lot of flow. Every manager under the sun comes through. You can do as many meetings as you want, and you're always within a kind of a phone call some of the smartest investors in the world, and they give you a tremendous amount of responsibility really early in your career, which gets you up the learning curve even faster. So I remember talking kind of 25, 26 years old, and you're sitting across the table from folks that have made their investors billions of dollars simply through their investing acumen. It's a pretty cool seat to be in, particularly talking to some of my peers that don't really get that experience, and then you sort of get used to it after a little while, which is kind of a cool seat to be in, because of course these world famous investors are coming to meet us. Like, that's just another Tuesday at Grosvenor. So really cool experience. So also, you're surrounded by a team of people that have done this for many decades and have kind of seen everything under the sun, all the successes, failures, different ways that people can prosecute investment processes. So you getting to learn from them as well. So seeing kind of both sides of it and learning from an LP and GP. And that's, so that's kind of like the great part about starting my career at Grosvenor. And then as you progress throughout your career, getting increasing responsibilities, clients had a lot of different ways that they wanted to approach hedge fund investing, and kind of understanding that, like, when you're 22, you're like, of course, everybody wants to annualize at 30 and is willing to kind of take this crazy amount of vol. And then you kind of like learn what different allocators want from their investment program. And some clients want a 2 vol portfolio, some clients want a 15 vol portfolio, and those are very different collections of managers. And there's managers that can build their firms to target each of those investment bases, and just being able to be at a place where you have both of those types of clients and what the different processes look like, and kind of the philosophical underpinnings of why you would choose that. Tremendous learning experience. So those are another cool aspect of starting my career at a place like Grosvenor versus sort of when you're at maybe a smaller firm, or one with like 1 or 2 clients and they all kind of think the same way. You don't see that broad spectrum of different approaches to the investing world. So both seeing it from kind of what clients want from their hedge fund program and how the hedge funds are built to deliver that for clients is like a cool spot, and you're sitting in the middle of all of this. And then getting to kind of manage some analysts over time and help build folks' careers and train them was another cool dynamic of kind of progressing through the ranks at the firm.
It sounds like great experience. So how did you end up finding Loyola? Did you find them or did they find you?
I wasn't really looking for a job. I was happy at Grosvenor. I was kind of progressing through the firm. It's obviously, like I said, a very, very great, very cool place to work. You go and work every day learning something new. Katie Wyatt had taken over the Loyola endowment in December of 2018 with the mandate to institutionalize it. It was about $800 million at the time. She's going to hire a team in 2020. Obviously, COVID hit and delayed everything. So that pushed out her hiring plans by about a year. She hired my colleague in March of 2021 and was looking for a 4th seat to fill out the investment team. I'd gotten connected with her just through the network. Obviously, I was based in Chicago, actually two blocks north of Loyola's office, so didn't move very far. But got lunch with her, and she kind of laid out her vision for what Loyola Chicago endowment would look like and what she wanted to do with it. And it sounded like a really, really awesome opportunity to join kind of ground level and help build the culture of an endowment. So decided to make the jump to the endowment after hearing her pitch.
And how about the team? How is the team structured today? So for those of us who are less familiar with Loyola and the structure of the endowment and the team responsibilities, could you share some of that for us?
So Katie runs the group. We're a 4-person team in total. We have Eric, who's the head of operations, and then Mike and myself do all the manager sourcing, research, diligence, monitoring, kind of on the ground activities day to day with the managers. So the 4 of us comprise the team. I generally cover marketables. Mike covers private equity and VC, and then we tag team everything else in the portfolio.
Before we talk about the underwriting process and asset allocation, I know Tim and I both have a lot of questions on that front. I mentioned something during your biography, moving to specialist equities model and how it impacted the endowment's performance. Could you talk about some of those improvements that took place during that process, kind of setting the stage for the listener to better understand what the motivations were, when Katie came in, and the progress towards that more specialist model?
Of course. So the portfolio that we inherited was built during the early to mid 2010s. We had a lot of generalist long-short equity, generalist long-short credit. This within the hedge fund book specifically, and then in the long-only book had a lot of kind of your classic asset managers, all very good firms delivering kind of exactly what they're supposed to be doing. The team, when we all kind of got together, did a lot of work thinking through how we wanted to position the endowment, the types of firms that we wanted to partner with, and kind of came to the conclusion that one of our key advantages is our size. So we're $1.2 billion endowment, as you mentioned. And per my comments earlier about there's different firms for different clients, a lot of firms are built for very large clients and are intended to be able to deploy kind of 15, 20, 30, 40 billion dollars. And we thought there was an opportunity in firms that are built to manage kind of $1 to $2 billion. And kind of that's like where the sweet spot is. And at our size, we could effectively deploy a lot of capital into those firms and have it as a large percentage of our assets. Whereas a lot of our peers might have sized out of it. We're obviously a small, mid-sized endowment. We're based in Chicago, $1.2 billion. We're not writing massive tickets. There's allocators in the world that are writing tickets that are larger than the size of our entire endowment. And we fundamentally believe the firm you have to build to manage like significant pools of capital is much different than the ones that you need to build to manage kind of $1 to $2 billion. And that the managers that can do that, we think they can access kind of specific niches that generate really attractive returns. So the shift to the specialist model, we kind of bifurcated the hedge fund book into two parts. About half of it's in sector specialists, largely healthcare and TMT, and then we have a generalist mid-cap manager, long-short mid-cap. And we thought both of those areas were ones that these folks are really earning the hedge fund fees. They have a clear edge, right, to win in these spaces, and they can kind of generate alpha in a way that you can't capture in other parts of the book. So there's this clear thesis about these areas and kind of the ability to deliver alpha in those areas. And just to clarify, when we say sector specialists, we're not necessarily taking a bet on the sector itself. So it's not a beta trade. It's truly a bet that the opportunity set within this sector is rich enough that whatever construct you're approaching it with, be it long biased, long only, or really low net, there's enough opportunities within it to generate alpha regardless of the total move of the sectors. So take, for instance, the biotech sector did a handful of 50% drawdowns sequentially, and then really choppy and basically flat since we've kind of been in the space. And the manager has been able to generate pretty strong returns given the amount of idiosyncratic alpha that's available within the space, kind of given the event-driven nature of kind of biotech drug readouts, FDA approvals. There's pure catalyst, and you kind of know whether the value's up or not. You're not relying on other people kind of coming around to your view. Similar thing in TMT where there's going to be winners, there's going to be losers, and if you pick a talented manager, they're going to be able to capitalize on that. So that was really kind of our thesis around the shift to sector specialists, is that there's true benefits to expertise within these sectors, and that the alpha that they're generating is going to be there regardless of where the sector moves. And then we're kind of partnered with the right folks to access the opportunity set.
So it's a relatively small team. How are those top-down decisions made? So when you think about the compass and you need to point in a specific direction, I realize and we recognize it's not a whiteboard. You know, when you start out, there's already an asset allocation model in place. But when you think about the compass with governance, how do those two work together?
One of the very cool parts about joining Loyola was effectively a whiteboard when I started. Katie had the mandate to institutionalize the investment office, and with that was able to kind of implement the program. One of the other benefits is that we have a fantastic board at Loyola that oversees the investment program, so we have a really collaborative nature with them. And we're always trying to think from first principles, like what's the right approach to managing the endowment, and not necessarily trying to just emulate some of our most successful peers. And we thought it was kind of important to kind of think through like specific objectives, requirements, and the other factors unique to us at Loyola to determine this optimal approach for managing the endowment. And kind of one of the most important aspects when setting strategy for a pool, particularly for E&Fs, is understanding kind of liquidity needs, how much capital needs to come out of the pool each year to support the actual organization. Because at the end of the day, we're really here to support Loyola Chicago, to support these students, to support the professors, support the administration. There's to build new buildings, and just kind of keep the organization running. So it's really critical that you kind of always have that in mind, that you're investing on behalf of a much larger organization with this really important purpose. So that obviously has a massive impact on how you think about rationally allocating the capital. So all that said, we had to kind of think through all these different various requirements and kind of what our role was in relation to the school itself. Obviously, if there's a huge draw on the endowment every year to support the operating budget, you're going to manage the portfolio in a lot different way than if there's a pretty limited draw and you kind of invest more aggressively. Luckily, we are in the latter camp, where the university doesn't rely on a huge draw from the endowment every year to support operating budget, which gives us a little more flexibility to take a little more risk with a commensurate return, and invest for kind of a really long time horizon and stomach some periods of volatility that you'll inevitably encounter when you're investing. So we spent a lot of time working collaboratively with the board, proposing different models, kind of modeling out different asset classes, historical returns, prospective returns, and kind of how they all fit together to kind of come to the conclusion for our asset allocation and how we wanted to, at a high level, kind of the bands within which we wanted each strategy to sit.
One question, do you use a consultant to help you at all? In addition to the board, do you use any third-party advisory services?
We do use a consultant. They're really helpful in thinking through kind of some of these high-level things, understanding how our peers are set up, the different requirements that led to those asset allocations that our peers have, and kind of the process of building up to those allocations. So it's been really helpful to have the consultant there as kind of a sounding board as we're thinking through some of these themes. As you mentioned, we are a small team, so it's always helpful to have an external party to kind of bounce ideas off, especially when they've seen a lot of different strategies and different models and how they work over time.
So when you think of all of that, Sam, when you look back to 2021, 2022, how was that capital deployed?
I think one of the key parts of running an E&F is having an alignment with the board and really being philosophically aligned and having them really believe in what you're trying to build and kind of seeing this long-term vision. As I mentioned, the team kind of came together in 2021. Obviously, the markets were pretty ebullient, and our prior allocation had pretty limited allocation to private markets. And a lot of our peers had very large allocations to private markets. So that made the performance kind of at the end of 2021 look pretty challenged. Still great performance on an absolute basis, but relative to a lot of our peers, lagged. And that's because our peers had built up these private market books, fantastic private markets books, but it took kind of 10, 15, 20 years to really build the reps and get the manager relationships in place and really build this fantastic private markets program. And then in 2021, you could have said, look, all these folks that are doing so well have 25, 30, 40% of their capital in private markets. We're at 8%. Let's go deploy 32% in private markets today. And you could have done it because all these venture capital firms, private equity firms were kind of coming back to market 3-4 months after they raised their first fund. And you can deploy a lot of capital really, really quickly. We said to the board, we don't think that's the prudent approach. I mean, you can deploy a lot of capital really fast. We don't think it's really the right time to do it. Look, all of our peers have spent a lot of time really thoughtfully, diligently building up these relationships, understanding where they're allocating capital, and just really, to hammer the word, but thoughtfully building their programs. And we want to do the same. So the board really understood where we were coming from and agreed with us and said, yeah, please be patient, be diligent as you're building this out. My colleague Mike's done a fantastic job building out the private markets relationships and really understanding who exactly we're partnering with and building these kind of long enduring relationships that we think will pay dividends to the community over a very long time period. Thankfully, we were patient because 2022 is a very, very challenged market, and it's given us actually a lot of opportunities to build relationships with really, really high quality firms, just given some of the challenges the private markets have faced since the kind of heady times of 2021.
So Sam, as we dig deeper into the investment process and the portfolio, maybe just starting high level with those conversations with Katie, Mike, yourself, and the team and the board, you settle on an asset allocation decision, right? Whether it be on the marketable side, on the private side. Can you give us a sense of that research process, how you're sourcing managers, and just kind of where that process starts and how it ultimately leads to a decision?
So I'd say philosophically, we're seeking to partner with the 40 best managers in the entire world. Obviously, you're never going to hit that, but if that's your goal and you get halfway there, you're going to have a really great result. So our process really starts with really understanding the asset class that we're targeting. I think one of the biggest issues that you face in my seat is this huge asymmetric information. If you're truly partnering with the best folks in the world, they better know a lot more about whatever topic you're discussing than you do. And just kind of given that dynamic, sometimes it's a little hard to tell like who's actually the best in the world and who kind of can just talk the talk. So the one thing I think about a lot is kind of like, I don't know if you guys ever heard Richard Feynman's cab driver knowledge anecdote, where he's getting driven around to all these lectures and he's giving the lecture and the cab driver hears it so many times that he says to Richard, hey, next time let me do the lecture. I can do it off the top of my head. So then Richard said, yeah, sure. So Rich Feynman sits in the back, puts on the cab driver hat and the suit, and this guy goes up and gives the lecture. And then somebody asks the question, asks a tough question at the end. And the cab driver says, sir, that question is so basic, even my cab driver could answer it. So I think about that quite a lot. And like if you go read a bunch of research pieces and you kind of do surface level work, you can kind of like talk the talk, even if you might not necessarily walk the walk. And as an allocator, it's obviously my job to figure out whether you're doing that or not. But without some kind of depth of understanding of what we're talking about, it can be really hard to differentiate between kind of the cab drivers and Richard Feynman of the world. So our process really starts from kind of getting not necessarily deep knowledge, because we just don't have the bandwidth to really get super deep on specific topics, but really have enough understanding to really be kind of fluent and have a real conversation with the managers and ask the right questions that can expose areas of gaps in knowledge.
Perfect. And then just digging into that investment process, right? It sounds like a lot of conversation, a lot of meetings with managers, right? Getting that knowledge from them. But how much work do you do aside from that on your own end, whether it's more quantitative, right, on the marketable side, what's available to you, maybe in the hedge fund space, but if you could speak to the private side as well, kind of what does that process look like from the underwriting and due diligence?
So I'd say once we kind of have a general understanding of the asset, we'll try to build a market map and identify every manager that we can in the space. Like I said, we have a general preference for smaller managers, but it's not what we do exclusively. So we think every strategy kind of has the right size. So try to determine like kind of the different characteristics that we would want in a manager that's attacking this opportunity set that we've identified. And then, like I said, build the market map and try to get every manager that we can find in the universe, and get all their materials, do as much background work as we can before actually talking to them, and really get a sense for the different players within the ecosystem. Once we do that, we'll try to narrow it to kind of a short list of managers that we think are from our first read exceptionally talented and kind of have the right characteristics that we look for. You obviously don't want to waste managers' time. So if you're never going to do anything, I'm not going to do 7-8 managers with meetings with a manager and then tell them that I'm not interested when I knew from day one that I wasn't interested. So generally try to have do a little work just to be kind of fair to the folks across the table and really kind of narrow to a short list of folks where there's actually something that's potentially actionable. Once we have that, we'll dive into the actual single manager work. Typically starts with a manager meeting where you just kind of get the fact pattern from the manager themselves. So you run through kind of like background, philosophy, the team structure, the investment process, risk management, portfolio management, and maybe a little bit of market views today. And that's kind of your initial meeting. You get all that. It's just all the facts about the manager, how they run the business, who the key people on their team are, variety of facts. And then you'll get a data pack from the manager, and then go run the quantitative aspects. So the research process is really this combination of quantitative and qualitative. And then trying to marry them to get a really deep understanding of what the person across the table from you is really doing day to day and how they're executing against a strategy. From a quant perspective, you get kind of a data pack. You'll get this kind of single name attribution if they're willing to send it. Most folks are willing to send it. I'll say that to any manager listening. Kind of run that through our systems. and kind of understand where the managers have made their money, kind of the shape of the return stream. Is it really lumpy? Is it really smooth? Or there's one winner and a bunch of losers? Kind of understanding your hit rate, your slugging percentage. You can also assess out the style of the manager. So some managers will lean very heavily on the value factor. Some will lean on the momentum factor. Some folks will swing it all around. Understanding how they manage their book. Like in that first meeting, they'll tell you how they manage their book, and then you get the quant data pack, and then you can see how they actually have managed their book. And those things should ideally align. And then you can also really understand from the quantitative nature, just really like drilling into kind of where the manager's been successful, where they haven't been successful. And it really flushes out a lot of questions that you can go take back to the manager for kind of the follow-on meetings.
Before we flip over to more of the qualitative aspects that you find in a manager, just one follow-up question on the quantitative. You suggested a preference for smaller managers. Do you have a range of kind of what that means in terms of asset amount, or is it a team size? What do you mean by smaller managers?
Sure. So I think smaller managers might have been a misnomer. We think kind of one of our core beliefs is there's a right size for every strategy, and that can be a different range. Like obviously, if you're looking at a venture capital, a seed series venture capital firm, it's a much different dynamic than if you're looking at a distressed credit firm. And there's a right size for both of those strategies. So I'd say generally smaller is better in our opinion, just because it gives the manager a lot more flexibility. Even if you look at some of Warren Buffett's writings, he says he'd be annualizing at 50% if he were running $200 million, but he's running whatever trillion dollars of market cap today. So it's kind of just a much different dynamic, much different opportunity set, and we think that we want to make sure the managers are sized appropriately for the opportunity set that we've identified, and if they've kind of outgrown that opportunity set, they're too big. So I'd say rather than focus on small managers, we're trying to avoid the managers that have kind of outgrown the opportunity set that they've accessed and kind of where they've been successful over time, to ensure obviously historical performance is not indicative of future results, but we think it can kind of point to some level of skill. But if you've outgrown this opportunity set and you're doing something completely different, the research process is a completely different dynamic than if you're appropriately sized for the opportunity set that you're trying to access.
Got it. And then maybe flip side to the qualitative part of the investment process, any sort of insight you can provide to our listeners?
Sure. Not to harp on the cab driver analogy too aggressively, but we do like to do case studies. I can sit here and kind of walk you through high level what a good investment firm looks like, and I could sit across from a potential LP and kind of say like, we do X, Y, Z. And we think the rubber really hits the road when you start talking about case studies and kind of the actual work that you do and what you've actually done day to day. And kind of you can kind of drill into specific areas and really figure out what the manager is doing, what they have done, and then that's where they can really differentiate themselves from one another. So we rely pretty extensively on case studies with the managers, both historical and current. Historical, we like to look at big winners, big losers, stuff that might not have worked, and we really like getting writing or any sort of kind of written material that was highlighting the manager's thoughts at the time. So kind of historical letters are fantastic for that. If the manager writes a good letter, you can kind of see exactly what they're thinking, their thought process, and then you can kind of follow it longitudinally up to where you are today, and really understand what happened, where the manager might have been right, what might have been wrong, what's attributed to skill, what's attributed to luck, and really understand whether the manager had done a good job with their work and then just got unlucky in the case of detractors, or had done a really great job and it was successful in the case of winners, or whether it was all kind of due to luck and they were doing shoddy research and not a good job. So I think that's really helpful on the historical case studies. And then the live case studies helps you solve the issue of kind of cherry picking, because you kind of pick a bunch of live names. Obviously, nobody knows what the future is going to look like. So then you kind of think through their thought process. And then as you kind of develop the relationship with the manager, you can kind of check in on that case study over time and how their thinking has changed. Within the case study, you can work through kind of research process, how they work with the team, kind of how they position size, how they monitor investments, kind of what their focus is on versus new investments versus current portfolio. And you can just flesh out a lot of different areas of the of the process through the actual case studies. Because at the end of the day, that's really what the manager's doing every day is this investment work and really trying to understand investments at a deep level. And then they can kind of walk you through kind of side by side with the manager what exactly they're doing.
So kind of the through line, and I think for myself, right, as an investment salesperson, fundraiser, calling on you, calling on the endowment and others, right, is transparency and communication and effectively over delivering on, right, the messaging, what's working, and in a lot of cases, what's not working, and being transparent about that in the portfolio.
Yes, it's really easy to tell when somebody's being deceptive across the table from you, and it's generally not folks that we partner with. So just being honest about mistakes, lessons learned from the mistakes, and obviously the best folks in the world have 55% hit rate, or they're wrong almost half the time. So any sophisticated allocator is going to understand that you're not going to get everything right. And then when you're actually demonstrating that you have this process to go back and learn from mistakes, walk through. Here's what I was thinking at the time. Here's where I was wrong, or what went wrong with the thesis. You can kind of really get a deep understanding, and it helps build the relationship with the manager and LP as well.
So Sam, thanks for going through obviously the mix and the asset allocation. How do you think about sizing of positions, right? It's a relatively concentrated portfolio of 40 managers. What do you think about it on both the public side and the private side of sizing?
Absolutely. So like you said, we're trying to build a concentrated portfolio where everything that we do really matters to the overall performance. And to do that, you have to take some concentration with the managers. It's a little different dynamic in private equity and venture capital because it's closed-end funds. So we're trying to build to this kind of 20% position within private markets, about 2/3 private equity, 1/3 venture capital. And we're trying to invest early and build kind of deep relationships with the GPs that we're partnering with. So we'll try to invest kind of fund 1, fund 2, fund 3, and then with the intention of kind of building to a core position over a couple of fund cycles. We're approaching our first re-up cycle, so getting to do that, and then start a little broader and then kind of pick the managers that you want to continue to build that relationship with. Like I said, Mike's done a fantastic job of kind of building out the network and just kind of making great relationships for us with these firms that are doing delivering really impressive performance. And kind of as we get through the J curve, we'll start really contributing to the performance of the endowment, and then get into those core position sizes. Similar dynamic in venture where we're doing seed and early stage, starting early with small managers and kind of building up to scale over a couple of fund cycles. Within the public and hedge fund side, we're big believers in concentration. So we're trying to keep it to 10 names each on the public and hedge fund side. We've got a range of sizes. So our top couple folks are fairly large, and then we've got some smaller stuff within the long only book. It's generally sized on kind of conviction and hitting those geographic weights. Within the hedge fund book, we try to size based on volatility. So like a lower vol manager, you can put a little more capital in. A higher vol manager will put a little less capital in. So then you can think about it as almost equal weighted on like a VAR or like vol basis, kind of however whatever volatility metric you want. Try to think about it as like kind of the dollars at risk in each of the managers is pretty similar, and that's kind of how we build the long only and hedge fund books.
Sam, thanks for sharing that. I'm curious, is there a place for fund of funds in your portfolio? Are you utilizing or incorporating any fund of fund strategies, particularly on the private side?
Yes, we partner with excellent venture fund of funds, and the intent was there's obviously within all of these asset classes, but particularly in venture, it's such a relationship-driven market. And if you haven't built these relationships over the past 25 years, you're kind of starting at a standstill where everybody is sprinting ahead. And some of the best funds in the world are managing kind of like $200-300 million in a seed fund and are 20x oversubscribed. So I've found that partnering with a venture fund of funds has been really fruitful way to kind of bring us up the learning curve on venture and ability to kind of scale, and then also a sounding board for understanding different career arcs. Because more broadly as an allocator, when someone walks into your office and you've never met them before, you're obviously coming in at one specific point in their life, but there was an entire career arc before that. And they can tell you what it is and they can tell you whatever they want it to be. But if you've been following them for a long time, you obviously understand the different dynamics dynamics and what happened, and XYZ firm might be saying this, that person might be saying that, and you actually understand what's truly going on versus one person's version of the events. That's really critical to actually having a deep understanding of knowing the folks that you're partnering with. And that just takes time to build. It just takes time in the market. It takes time meeting these people. It takes time kind of going to the conferences, understanding the firms, like talking to them over long time periods of time. And there's really no way to solve that problem other than doing it over a long period of time. So we've found that the venture fund of funds, rather than meet 20 venture funds and be like, oh, this guy's good, that guy's good. Like this lady is like really impressive. Like that lady is doing something really cool. And then you can go bounce it off the VC and they'll say, oh, well, did you look at this? Did you look at that? Do you know about this? So then can kind of really be a sounding board to help us bring us up the learning curve and really understand some of the nuances of what's going on and make sure that we're partnering with the best folks in the best folks in the world. I keep coming back to it. We're trying to partner with the 10 best folks in the world in each asset class. And to do that, you really need a lot of experience. You need the expertise and like just knowing what's really happening within these asset classes. And we found the venture fund of funds has been really, really helpful in that regard.
It sounds like collaboration is the thread through all of this.
Yes, absolutely. We think it's really, really critical. Also, we're a team of 4. We try to collaborate pretty actively with other ENFs, family offices, pensions, fund of funds. Just try to be part of the community and kind of share ideas and kind of what we're seeing and hearing what other folks are doing. So like just collaborative nature in general, and everybody is, for the most part, is investing on behalf of really good causes. And if something that I can do to help Loyola can also help another endowment or another foundation, I think that's generally net positive for the world. So always happy to share what we're doing, what we're seeing, what we're thinking.
A good Jesuit school.
Yeah, we try.
Speaking of those ideas and what you're seeing, obviously our listeners are always curious as to where you all are focusing your time and energy, kind of opportunities going forward. I know you touched on the re-up cycle on the private side. I'm sure that's taking Mike and the team's time, but is there any areas on the private side that's more interesting for potential new allocation as well as on the public side?
Absolutely. We think there's a huge evergreen opportunity in lower middle market private equity. There's a massive opportunity set to target companies, really attractive purchase prices, a true opportunity to deliver value through kind of low hurdle operational improvements. And you have a natural exit to these larger private equity funds that are sitting on a tremendous amount of dry powder and need acquisitions. So if you're a low middle market private equity firm that can actually deliver these operational improvements and kind of get the company in a place where a large private equity buyer would buy it, or many large private equity buyers would go into an auction process to buy it, you have this kind of natural uplift to multiples. You get the EBITDA expansion during the ownership period, and you can realistically underwrite really, really attractive MOICs on these things at kind of a low risk because they're real companies that you're buying. It's already there. You just have to kind of do these things, and you have a playbook and expertise in how to do it. You've done it hundreds of times. It almost becomes like a machine almost. So I think that lower middle market private equity is really, really attractive. On the private credit side, I mentioned a lot of these private equity funds are sitting on historic levels of dry powder. They're also sitting on historic backlog of companies that they need to move off their funds. So I think that there's an opportunity in capital solutions strategies where some of these private credit funds can provide interesting solutions to private equity funds, where you're kind of sitting high up in the capital structure and bridging these groups to exit when they're unable to put in new equity or kind of continue funding their companies, but need some solution where that's not a fire sale of the company. Some of these capital solutions folks can provide financing solutions, really attractive rates, high up in the capital structure with really, really attractive downside protection. So you can kind of realistically underwrite it to a mid-teens IRR. The concern there would be reinvestment. So I'm not entirely sure that's an evergreen opportunity set. We'll see what happens with the private equity exit market. But I think that's a really interesting area that we've been doing a lot of work on today. And then on the public markets, I think that's obviously an evergreen opportunity. We have 45% of our capital in the space, but there's a lot of names that have really gotten left behind in the bull market, and we think that there's a lot of really high quality companies outside of kind of this narrow market that have been left behind but are continuing to grow. Really high quality, defensible businesses that can generate a lot of capital. And I know everybody says it, but we truly believe that there's a benefit to having long duration capital. And I guess that's one of the roles as an LP, particularly at a place like Loyola, where we're investing for decade-long time periods, even more than a decade. We're kind of generational investors. Is really communicating to the managers that kind of we have their back, we're supportive of them in periods of volatility, and that we kind of truly believe in what they're doing, so that they're not really worried about potential redemptions or, we have to show like near-term performance is really good, that they can truly invest in the best opportunities that they can find for a kind of 3-4 year time horizon, and that we as LPs are willing to stomach a little bit of volatility to get there. So I think that's one of the areas where LPs can add value to GPs. But then circling back to the opportunities, there's been a lot of volatility, particularly in mid-cap names, around kind of near-term concerns, or anything with an overhang just gets hammered on perceived bad news. And if you're partnered with managers that know the names really well, and can kind of step in during those periods of volatility and have an outlook for that 3-year period, and more importantly, have the capital backing them to actually hold through the volatility, I think you can generate really, really attractive returns in public markets today.
Sam, thanks so much for all of that insight and intelligence. So now all of it has come together. You have all of the ingredients for the recipe. So what does that cake look like in terms of the mix of assets, both on the private market and public market side?
We're about 45% long only, 20% hedge funds. We have a target of 20% for privates. That's about 2/3 private equity, 1/3 venture capital, about 7.5 points of fixed income, 7.5 points of opportunistic, which is a variety of different strategies, but largely private credit in real estate. So that's overall the asset allocation. Within private equity, primarily do lower middle market private equity. I think that there's a tremendous opportunity within that space. And then within venture capital, we're largely focused on seed and early stage investing. I think those are both really attractive areas, particularly for an endowment of our size to access. Within publics, we loosely match the MSCI World from a geographic and industry standpoint. That's within bands. We're not going to try to match it really closely. So generally try to be within kind of 10 percentage points of on geos and 10% on the industries. But we're willing to take a little bit of basis risk there, just because we don't want to be redeeming and adding to managers, or trying to do an overlay on the back end to try to match it up over very short time periods. It's something that we reassess every kind of quarter, 6 months, to really understand where we're at, and if we need to make changes there to maybe tighten up the benchmark, or if we're taking risks that we don't necessarily intend to make, but have just done through the managers that we picked and what they're doing on their end. Overall, we run a fairly concentrated portfolio. Like I said earlier with Tim, trying to find the 40 best managers in the world. We have about 4 asset classes, so call it 10 managers per asset class. I'm trying to keep it fairly tight group, because kind of there's somewhat of a dynamic when you're an allocator. Everybody that you're meeting is really, really intelligent and doing really interesting things. And kind of you can have this dynamic where the last thing you heard is the most interesting thing you've heard, and then get this kind of drift in manager count, and the manager count rises. And then you find yourself with a portfolio of 40 long-only managers, and your look-through exposure, your biggest position might be 50 bips, and you've got 1,000 line items on the look-through basis. So we're trying to avoid that dynamic and really force ourselves to think through, are these the 10 managers that we want to partner with? Are they the best? And if something new comes along, like, we need to find capital for it from one of these managers, rather than just kind of trimming everybody a little bit and letting the manager count creep up and up and up.
How concentrated are those managers? So we get asked often about how our allocators that we speak to define concentration. It sounds like you have a concentrated book of managers, but when you think about the number of positions that those managers are holding, how do you define concentrated?
Sure. So half the people that I talk to think we run really concentrated managers, and half the people I talk to think our managers are way too diversified for them. So we're somewhere in between. Our sweet spot's somebody that runs kind of a 7, 8 to kind of 20 names. We have a couple managers that run 50, and we think they do it really, really well. We have some managers that run 8. I know there's a lot of managers out there that run kind of 2 to 3 name portfolios. Not saying it's something that we couldn't do. We've looked at a lot of them, but it's something that we haven't done yet. We think that is just kind of a unique skill set that you need to manage a 2 to 3 stock portfolio, and some of the underlying volatility makes it tough as an allocator to size that position up commensurately. And then you wind up in the same problem where if you take a bunch of managers that are running 3-name portfolios and you've got 40 of them, like your underlying portfolio is a bunch of 50 basis positions and you kind of defeated the purpose of concentration. So we found a little more comfort in being able to scale up folks that are kind of in that 8 to 20 range, and you can take a little bit chunkier positions and then get that underlying look-through positions, where our look-through positions might be a little larger than the folks that are running the 2-name books, like a portfolio of 2-name books. Our look-through might actually be more concentrated than them, with a lot better kind of vol characteristics at our level.
I may have missed it, but when you talked about the mix, did you mention co-investments? I'm just thinking about those 2 to 3 stock portfolios, those single company names. Do you ever participate in co-invests?
We've done a handful of co-invests. We've tried to tread lightly there, and really focus on people that, one, don't bring a lot of co-invest, and two, kind of only do so when they have something that they think is kind of a once in a couple year opportunity set. So we've done a couple. I've generally tried to, most of the things with the endowment, we try to be really diligent and thoughtful and, I guess, not necessarily slow, but really thoughtful and treading carefully in these areas, because there's a lot of different ways to lose money in the stock market, and we're obviously investing on behalf of a university. It's really critical to focus on the risk side of the spectrum, and really make sure that you're entrusting your capital and putting your capital in areas where there's a strong risk-adjusted return. And we thought, kind of get our current roster of managers in a place where we want it, and then we can explore co-invest a little more. So it's an area that we think's interesting, but really want to understand what we're doing, kind of the philosophy, the strategy, and the appropriate way to approach it to actually enhance returns.
I wouldn't be a good host if I didn't do a little digging prior to the interview. I found a presentation that Katie Wyatt did called "Managing the Enterprise Risk in Institutional Portfolios." Truth be told, we could do an entire episode just on this presentation. It was incredibly insightful. I highly recommend to our listeners who are interested in calling you with a strategy to take a look at that presentation in advance. So rather than asking you a litany of questions about that presentation, I'll just ask you something a little bit more simple. What have you learned in working with Katie Wyatt over these years as it relates to your roles and responsibilities today?
Absolutely. So Katie's been a fantastic boss. I think it's been really, I keep using this word, collaborative, but the collaborative nature and just kind of her trusting me to go out and do a good job, and then kind of pushing back in the right areas. And sometimes you'll be worried. Obviously, anytime you start a new job, you don't really know who your new boss is going to be, and various places have different models. You can get people kind of just pushing down their favorite ideas, and you have to kind of get to yes to make the boss happy. It's certainly not been like that with Katie. It's always been like an honest, open discussion, really collaborative, trying to find, like I said, the 40 best managers for the endowment, and how do we go out and attack that as a team of 4. So it's been really, really great having her as the boss, and she's kind of like pointing me in different directions, understanding kind of where to look, key areas to dig in on, areas that I might have overlooked on when I'm underwriting a manager, and then really understanding kind of the portfolio as a whole and how it ties back to the organization itself, and really what we're doing here is investing on behalf of these students, these professors, and this institution that's been plays a really vital role in Chicago and the world, and it's really important for us to always keep that in mind when we're making these investments. So I think overall, just kind of like the overall sense for the importance of what we're doing, and then to even the nitty gritty of manager research. So it's been across the whole spectrum. I've learned so much from her. It's been really fantastic to have her as the boss.
Sam, thanks so much for all of this. We're at the top of the hour. We always like to finish these conversations with the people who have been most influential to you. I know career-wise, you're still in the middle innings, but who were the people that helped you get here?
Absolutely. There's obviously been a ton of people that have impacted my life. It's hard to name all of them, but like first and foremost, my parents have always believed in and supported me, from giving me the intelligent investor to giving me a little bit of capital managed when I was in high school and had absolutely no idea what I was doing. So obviously I have to start there. And then my dad always told me, like, don't forget who brought you to the dance. So I have to call out my first boss, Jeremy Joseph, who hired me into Grosvenor, and kind of that learning curve that I mentioned when you're starting off in your career helped me really accelerate up that, and it's been a great mentor and kind of continued friend over the years. And then finally, my boss, Katie, I think I talked quite a bit about all the impact she's had in my life. But she's been a fantastic mentor, and really, really happy that she's my boss.
So you mentioned in the very beginning of the conversation that economics and potentially being a teacher of economics was in the cards. Have they got you in the classroom yet at Loyola?
I've been in the classroom, not speaking. We try to bring in some of our managers to talk to the Rambler Investment Fund. So some of the students are in the investment club, similar to the one that I mentioned earlier, big. And we try to bring in, as the endowment, we obviously partner with all these managers, the managers in town. We try to bring them through to talk and give lectures to the students, and really open up a Q&A with the students so they can see how these professional money managers are managing the capital. And I think it's a really interesting experience for the students, and something that we've been trying to cultivate a little bit more.
That's great. Thank you for sharing that. Sam, congratulations on all your success. Thank you for being here today.
Thank you for having me. It's been great.
Yeah, we appreciate it. Tim, thanks as always for being here.
Thank you for having me. Thank you.
If you want to learn more about Sam and Loyola University Chicago, please visit their website at www.luc.edu. You can find this episode and past episodes on Spotify, Apple, or your favorite podcast platform. We are also available on YouTube if you prefer to watch while you listen. If you'd like to catch up on past episodes, check out our website at dakota.com. Finally, if you like what you're seeing and hearing, please be sure to like, follow, share these episodes. We welcome your feedback as well. Sam, thank you again for being here. Tim, thank you as always. And to our audience, thank you for investing your time with Dakota.
Don't say goodbye.